Welcome to part 2 of our financial statements video training. In this video, we continue our discussion of current assets, which will appear first on a company's balance sheet. We will focus on accounts receivable, the allowance for doubtful accounts, and inventory, including the inventory cost flows, FIFO and LIFO. Please print the PDF handout shown below this video as it will be used throughout the training. Okay, the next line, accounts receivable, those of course come from having sold some merchandise or provided services on credit. So if we give somebody 30 days to pay, we have a receivable, and we call it an account receivable. And the ones that we show on the balance sheet are the ones that have not yet been paid. We use the phrase accounts receivable net because we want to subtract, and should do this, we should subtract an allowance for any doubtful accounts. So perhaps we have really 40,000 of accounts receivable, but we estimate that 2,000 will not be collected. And we might make that judgment or that estimate based on the fact that the customer hasn't paid in 120 days and they should have paid in 30 days. And so now we're getting a little worried, or we're here on the street that this company's in trouble, right? And then maybe we got another account that's 200 days past due. So it's a good indication that maybe we're not going to collect that. So we should put down some estimate of that and reduce that total amount down to a smaller amount. Yes?
Is there a threshold that you use when you're doing the net, when you're reducing that?
Mm-hmm. Okay.
Is it a threshold, a certain dollar threshold that you're looking for? Or is it a percentage? You know, like is it 2%, we'll take off 2%, 5%?
Okay. So we have a question, is there a threshold for this? Or how do we do that estimating, right? How do we make that decision, right? Because we hope to collect it all. And so what do we do, right? So my suggestion is you go through each of those past due accounts and sit down as a team and say, what's the feedback when we call? Are we getting payment? What kind of message are we hearing? What else do we know? Maybe check a credit bureau. And so it's going to be a judgment call. It's definitely an estimate. So the point that we have to make here is that putting in any estimate is better than putting in nothing. So if we have 40,000 in receivables and we got some shaky ones, rather than saying let's ignore that and list the whole 40, it's better to say, well, maybe it's 500 to 2,000, I'm not sure, and we compromise and put 1,300 in. So it's an estimate. Again, if 1,300 is better than 0 if there's really some shaky accounts. One rule of thumb would be the older the receivable is, the more past due the receivable is, the bigger percentage, right? So in academic textbooks, we'd say stuff that's current, we don't have to allow anything for that. And maybe stuff that's 30 to 60 days past due, maybe we'll put in 1%. And then maybe if it's more than 120 days past due, maybe we'll put in 25%. But those are arbitrary things for teaching, and so you'll see those around. But the best thing is to review your accounts and make that communication with the customer and start getting some progress payments. If you can't even get a small progress payment, that's sending a signal too that maybe I better increase that. So great question. Okay, the next line on the balance sheet is inventory. And that's the merchandise that we bought and plan to resell. That inventory is shown at its cost, not at what it's going to sell for. And then we might actually reduce the amount to an amount lower than cost. So again, inventory is at cost, but we may reduce it to an amount lower than cost. And the reason we might do that is some items might be not turning. They might be obsolete. So we have a term or a rule called conservatism. So an underlying guideline for us is called conservatism. And that says when doubt exists, use the lower number. So if we have an item that costs us $6 per unit